The IRS just quietly turned on a tax that most people don't know exists. It doesn't hit the person who renounces U.S. citizenship. It hits their family, their kids, their grandkids, and the rate is 40%. Today, I'm going to walk you through exactly what this tax is, who gets hit by it, and how families plan around it before it's too late. I'm Vincenzo. I left a Wall Street career 15 years ago to live abroad, and I've been running an international tax firm ever since. My team has helped hundreds of Americans renounce U.S. citizenship in the right way. And this is the exact rule I've been warning clients about for years, and it just got fully enforceable. 3 things: what this tax actually is, who gets hit, and for how much, and the specific ways families could plan around it before it triggers. Here's what happened. Back in 2008, Congress passed a rule called Section 2801. It was aimed at Americans who renounced U.S. citizenship and later gave money or property to family members still living in the U.S. Without this rule, wealthy renouncers could give millions of dollars to their kids tax-free, which Congress considered an unfair loophole. Section 2801 closed that loophole by shifting the tax burden to the person receiving the gift. 40% paid by the U.S. recipient on any gift or inheritance from a covered expatriate above the annual exclusion. For 18 years, the rule sat on the books with no way to actually enforce it. The IRS never released a form. In January 2026, they finally did. Form 708. The tax is now fully enforceable, retroactive to gifts received in 2025. So who does this apply to? 2 boxes need to be checked. First, the person who renounced has to be called a covered expatriate. That means they have a net worth of $2 million or more when they renounced, or their average tax bill for the 5-year period was over the threshold, or they couldn't certify 5 years of tax compliance. Second, the recipient has to be a U.S. citizen or U.S. resident. If both are true, the 40% tax applies to every gift above the annual exclusion. That exclusion is $19,000 currently. Now, let's talk about what this actually costs in real dollars, because the numbers get big real fast. 3 scenarios we see with clients. Scenario 1, the parent renounces, then gifts the money to their kid. A parent renounces U.S. citizenship as a covered expatriate. 5 years later, they give their U.S. citizen daughter $500,000 to buy a home. Their daughter now owes the IRS $192,000 in tax on that gift. Not the parent, the daughter. The parent already paid the exit tax when they renounce. This is a completely separate tax, but it lands entirely on the recipient. Scenario 2, the inheritance case. A grandparent renounces U.S. citizenship, moves abroad, and then dies 10 years later. Their estate includes $2 million in assets they want to leave to the U.S. citizen grandchildren. These grandchildren owe $700,092 in tax on that inheritance. There's no statute of limitations on this. It doesn't matter that the grandparent renounced a decade before. The 40% tax still applies. Scenario 3, the trust distribution. A covered expatriate funds a foreign trust. Years later, that trust makes a distribution to the U.S. beneficiary. The portion of the distribution attributed to the covered expatriate's contribution gets hit with the 40% tax. This one catches even the most sophisticated families off guard, because trusts are often used to reduce tax, not create it. The key point across all 3 scenarios is this: the person who renounced is not the one paying the tax. Their U.S. family is. That's the design of the rule. Which brings us to what actually matters, which is how families avoid getting hit by this in the first place. 2 strategies. Both have to happen years before the renunciation, not after. Strategy 1, avoid covered expatriate status entirely. The 40% tax only applies if the person who renounced is a covered expatriate. If they're not, none of this ever kicks in. The most common way to avoid covered expatriate status is to gift the assets before renouncing, so the net worth stays under the $2 million threshold the day of the renunciation. The lifetime gift and estate tax exemption is $15 million for 2026. So there's substantial gifting space that you could use. But timing matters. Gifts made in the same year as the renunciation are treated as still owned by the renouncer. So to be safe, gifting assets should happen 2 to 3 years before renunciation, minimum. Strategy 2, gift before renouncing, not after. If someone is going to renounce as a covered expatriate anyway, the goal shifts. Any gift before renunciation falls under the standard U.S. gift tax rules with the $15 million lifetime exemption. Any gift made after renunciation triggers the 40% recipient tax of the family member. The math is simple. Gifts to U.S. family members should happen while the person is still a U.S. citizen, not after. Here's what most families miss. Retirement accounts, life insurance policies with U.S. beneficiaries, and trust interests all have their own separate rules under Section 2801. Even families that plan direct gifting piece correctly can get blindsided by these. This is why the planning around renunciation for anyone with U.S. family has to be handled by someone who actually understands the interaction between the exit tax, Section 2801, and estate planning. Get one piece wrong can undo the entire strategy. Here's the honest summary. The IRS quietly turned on a tax that hits the wrong person, not the renouncer, but their family. And now that Form 708 exists, it's fully enforceable and retroactive. Families that plan this correctly, years before renunciation, can often reduce this exposure to zero or close to it. Families that don't plan learn about Section 2801 when the IRS sends the letter, and by then, it's too late. If you're seriously considering renouncing U.S. citizenship, the smartest thing you could do first is understand if it's even the right move for you. The next video on the screen breaks down exactly why most people who think they should renounce actually shouldn't, and the specific situations where it does make sense. Watch that one next. And if you or someone in your family is looking to renounce, the link below will get you on a call with our team. This kind of planning takes years to execute properly, so the earlier you talk to someone, the more options you have.